And let's put that to our next guest, Jahangir Aziz, the Global Head of EM Economics at JPMorgan. Jahangir, again, thank you very much, like Robert, for staying up for us. What's your sense? Do we have to take this as a negative message at all? Although the stocks fell, is this ultimately telling you that a soft landing is possible?
Look, I think the market was over-exuberant about a March rate cut. That's one of the things, right? And therefore, there was a lot of positioning, hoping for a March rate cut. So the reaction today, most likely, and I'm not exactly an expert on equity positioning, but I'm guessing a lot of it has to do with positioning. And as Robert said, look, what ultimately comes out of the Powell statement is that he's becoming very, very comfortable with the idea that you don't really need a recession to get inflation down to that 2% level. In fact, they've already achieved 2% at the PCE level, and they expect few more data points to confirm that. And the fact that he's so comfortable with the idea that you really do not need a massive slowdown in the economy means that, a rate cutting cycle is at hand. It is obviously not going to be in March. But, May, June are now very high probability dates at which the Fed will start its easing cycle.
Okay. Jahangir, hi, good morning, and thanks for joining us in a big day today. What is the expectation in terms of the fiscal deficit number this time around in the budget? Do you think, given that it's a pre-election budget, don't have your hopes too high in terms of fiscal profligacy? What is the number that you're going with?
So first of all, look, it's an interim budget. Right, so let's not get too excited about it, right? My guess is that given the fact that they have been hell-bent in proving that they can stick to the fiscal consolidation line that they had announced, my guess is that they are going to target the 4.5% 2 years down the road. I'm cutting the difference in the middle, and I'm saying that it's going to be a 5.2% fiscal deficit target. This is not, it could be 5.1, 5.3, but I'm guessing it's somewhere in the middle. So 5.2% is my number for, this budget. And again, there's an interim budget. Let's keep that in mind.
No, absolutely. Jahangir, hi, morning. Prashant here. Just to sort of, we're going to, toss you from one to the other, budget and global. So back to the global, the 10-year fell about 10 basis points in the US last night. It's not the Fed, it's this, once again, festering regional banks in the US, because most of that fall happened before the FOMC decision, etc. Is that, once again, going to be a bit of a worry at the margin?
Right. So once again, if you look at the morning place, it actually started with the ECI number actually surprising on the downside. Right. So that was when it actually fell. Then again, the next drop that takes place is after the Fed speak. Look, in the March event when you had, rates going up close to 5%, and then you had the major banking event, I think people have very bad memories of that. And I think people still haven't recovered from that episode. So I think there's some of that obviously going through, but I don't think that a 10 basis points drop when the Fed more or less said that they are probably going to start cutting rates not in March but very soon thereafter is that big of a surprise event. If you look at where the 10-year was, before the ECI number and at the end of the day, they're broadly the same.
Jahangir, are we really picking holes in what is a superb Goldilocks time for us? I mean, look at the US numbers, GDP numbers, the way they have surprised 50% more than what people expected. People expect 1%, it gives you 2%. Likewise, core inflation, especially in Asia. It's surprising on the downside month after month. It's a great moment. This is going to be a good at least 6 months. Can we take that Goldilocks to continue for some time?
Sometimes, Latha, we like to look at the gift horse in the mouth. So I think we are doing. I think, a whole bunch of us had this view that, look, the last mile of inflation is going to be very, very difficult because the first 2/3 or 3/4 of the inflation decline was essentially being driven by the normalization in the supply chain dynamics, and therefore the last mile will require some sacrifice to be made from growth. Growth is surprising on the upside. The supply side normalization, that is also fading away. And therefore, there is this concern that, well, you're not going to get the last mile. But in line with what you said, I think, look, even if the last mile is not reached, right? So let's say the Fed doesn't even make it to 2%, but somewhere the market expectations and the rate cuts are not hinging on the Fed actually hitting 2% and keeping it there. It is a trajectory that inflation is on the path towards that 2% mark. That is sufficient for the Fed to start cutting rates as long as the Fed is convinced that the path, that trajectory is actually there. And that's all that the Fed is asking for. Few more data points that the trajectory is actually being maintained. And I think that's about all it requires. And I think, and I agree with you, look, even 6 months back, if you'd said that, in the month of January, we would be looking at a world where growth is surprising on the upside, inflation is surprising on the downside. Central banks are poised to cut rates. Some central banks have already started to cut rates. You wouldn't have believed us at all. Believe me at all.
Absolutely. Latha was talking about growth in the US, right? So I wanted to bring that discussion back to India. Because, the finance ministry put out a review the other day saying that the economy will grow 7% in FY25. They're looking to become a $7 trillion economy by 2030. In this budget itself, what do you think the growth measures could be that the government can announce, despite it being an interim budget?
And if I can add one more to that, the growth expectation is a big question. Tax buoyancy, what would you think is a par for the cause? But more importantly, Jahangir, is it okay if they, breach on the fiscal deficit? After all, look at core inflation. Why are we worrying?
So the worry is not there, Latha. So let's look at the context of India's growth. So we can quibble about where the growth momentum is faltering. You've had 4 straight months of industrial production momentum slowing down. Global economy is slowing down compared to what it was before, even though it's doing very well given expectations. But whether we go into that quibbling about the last second decimal or not, growth is going to hold up reasonably well around the 5.5–6% in the remainder of this fiscal year and in 24–25. Inflation is on the downtrend, even though it hasn't reached the 4% magic number for India. It is on track of doing that. Once the Fed starts cutting rates, even the RBI will start cutting rates. So what the fiscal does not require to provide another dose of fiscal support in 24–25. And I think that should be the starting point. Instead, what we have are 2 separate issues facing India. One on the fiscal front and the other in the economy. On the fiscal front, despite the fact that we will achieve the 0.5% fiscal consolidation this year, that 0.5% fiscal consolidation was entirely on the basis of tax burdens. There was very little expenditure compression that took place. And if you look at the stock of debt actually rose from around 80% to about 83%. And just to stabilize the debt stock, you will require the overall public sector deficit, and I'm not talking about center versus state versus PSUs, but overall fiscal deficit, or overall public sector borrowing to come down by about 2 percentage points, just to stabilize it, even if you assume a very healthy, let's say 9.5–10% nominal GDP growth rate. So these are very difficult numbers. So the budget needs to consolidate and start consolidating now. And I think that that should be the way to achieving that 4.5%. You will need help from the state governments to reduce their fiscal deficit from the 3.1, 3.2 this year back to the 2.5%. Both of them need to be done just to stabilize the debt dynamics. So that's the first thing. The second thing is that while we are achieving these very, very strong overall GDP numbers, there are serious imbalances within the economy. Private consumption remains weak. Private investment remains subdued. If you look at the export fronts, it is largely being driven by services, not by manufacturing. As I just said, for the last 4 months, industrial production has actually been losing steam for last 4 straight months. And even within consumption, there is a huge gap between low-end consumption versus high-end consumption. Now, these are imbalances that are natural to happen when an economy is shocked by, global shocks of the kind that we've seen over the last 3-4 years. The concern is, are we closing those gaps, or are these gaps widening? And what should fiscal policy do? And I think the fiscal policy now needs to address these gaps and fiscal consolidation at the same time, rather than continuing to provide support to the economy. I think that's the basis of looking for a fiscal consolidation and the granularity of the budget, even though it's an interim budget.
Jahangir, thank you very much. Actually, there are two different narratives. If you read the economic review of the CEA, it looks like we are 7, 7.5, and just all guns blazing. And then, as you correctly point out, there are some weaklings in the growth story as well in terms of consumption.
Yeah.
Point taken, this debate will go on. Thank you very much indeed for staying up for us.
Sure.
Okay, well, that's the global and the emerging market scenario, the macros, but